What if I told you that the most powerful weapon in human history is not a gun, not a bomb, not even an army? What if the weapon that toppled empires, enslaved nations, and quietly transferred more wealth than any war ever fought, is something most people interact with every single day? It doesn't explode. It doesn't kill instantly. It doesn't even look violent. In fact, most of us were taught it's necessary, even normal. It's called interest. Interest is why entire civilizations rose and collapsed. Interest is why countries rich in resources remain poor. Interest is why debt never seems to shrink no matter how much is paid. And here's the mystery. If interest is just a price of money, why does it always flow upward from workers to lenders, from nations to banks, from the future to the past? Today, we're going to uncover how interest quietly became the most effective weapon ever created. Not through conspiracy theories, but through history, incentives, and math. And by the end, one unsettling question will remain: was interest ever meant to be repaid at all? To understand interest, we need to go back to a time before money worked the way it does now. Thousands of years ago, early civilizations didn't borrow money to grow. They borrowed grain, livestock, or tools, things that physically existed. If a farmer borrowed 10 sacks of grain and returned 11 after harvest, that extra sack made sense. Why? Because grain reproduces, animals reproduce, land produces surplus. Interest, in its earliest form, was tied to real growth. But here's the twist most people miss. Money does not reproduce. And that single mismatch, charging growth on something that doesn't grow, would eventually destabilize entire societies. The first known interest laws come from ancient Mesopotamia, over 4,000 years ago. Kings didn't just allow interest, they regulated it tightly. Why? Because even early rulers understood something dangerous. If debts grew faster than people's ability to pay, the result wasn't prosperity, it was social collapse. Records showed that when debt crises spiraled out of control, kings issued debt jubilees, mass cancellations of loans. Not out of kindness, but because if too many citizens fell into debt slavery, the army weakened, taxes collapsed, and rebellion followed. Interest was powerful but contained. That containment wouldn't last. The real transformation began when money itself changed. Metal coins replaced grain. Gold and silver replaced livestock. Suddenly, interest was no longer tied to biological growth. It was tied to time. And this is where interest became something new. A lender could sit still, produce nothing, take no risk beyond ownership, and yet grow richer purely through ownership of money. This created a new class. People who didn't need to work, farm, or build, only lend. Many ancient societies recognized how destabilizing this was. That's why ancient Greece condemned usury, Rome capped interest rates, major religions banned it outright. Not because they hated trade, but because they saw what unlimited interest did to social order. Yet, despite bans and caps, interest kept returning. Why? Because rulers themselves needed it. Wars were expensive. Palaces were expensive. Empires ran on debt. And whoever controlled credit, controlled kings. The real turning point came with banking. Medieval moneylenders realized something revolutionary. They didn't need to lend their own money. They could lend claims on money. This was the birth of fractional reserve banking, a system where banks create loans far exceeding their actual reserves. Here's the crucial shift. Interest was no longer charged on existing money. It was charged on newly created debt. This changed everything because now, the economy required continuous debt growth just to function. Let's slow that down. If all money is created as debt, and every unit of debt has interest attached, then more money is always owed than exists. The only way to prevent collapse, create more debt. This wasn't accidental. It became the engine of modern capitalism. Governments borrowed, businesses borrowed, citizens borrowed. Interest transformed from a fee into a structural obligation. And those who controlled lending controlled, who grew, who failed, who survived crises. Interest had become invisible power. Every debt system eventually hits a wall. Because debt grows exponentially, but real economies grow slowly. This is where interest reveals its true nature. Look at history. The Roman Empire collapsed under debt concentration. Medieval peasants revolted over compounding obligations. Colonial empires used debt to extract wealth indefinitely. By the 20th century, interest had moved from personal debt to national chains. Countries no longer conquered with armies. They were conquered with loans, infrastructure loans, development loans, emergency loans. Each came with interest, each came with conditions, and each ensured that repayment flowed outward, not inward. By the time nations realized the trap, they weren't paying principal anymore, they were paying interest on interest. Debt had become permanent. Here's the part rarely explained clearly. Interest doesn't just create debt, it rearranges society. Those who already own capital receive interest. Those who don't must pay it. Over time, this produces one unavoidable result: wealth concentration. This isn't ideology, it's arithmetic. When interest compounds, creditors gain without producing, debtors lose despite producing, and because money enters the system as debt, someone must be in debt for someone else to profit. That's why households can work harder yet fall behind, nations can export more yet owe more. Crises always end with bailouts for lenders. Interest ensures the system survives by sacrificing participants. Every generation tries to fix the problem: lower interest rates, debt restructuring, inflation. But these are treatments, not cures. Why? Because the core mechanism remains untouched. Money is still created as interest-bearing debt. Lowering rates doesn't remove interest, it extends the cycle. Inflation doesn't erase debt, it redistributes pain. Debt forgiveness is rare because forgiving debt threatens those who profit from it. And so the cycle repeats. Crisis, bailout, expansion, collapse. Each time, debt grows larger. Each time, interest claims a bigger share of the future. Today, global debt exceeds 3 times global economic output. Governments don't debate whether to borrow, only how much. Central banks inject money, but always through lending. Even rescue packages come with strings. Interest has become so normalized that questioning it sounds radical, yet the pattern is undeniable. Every major crisis increases debt, every recovery enriches creditors, every generation starts more indebted than the last. This isn't failure, this is design consistency. Interest doesn't need violence, it doesn't need force. Time does the work. 3 clear takeaways. Takeaway number 1. Interest is not neutral. It determines who gains without labor and who labors without gaining. Takeaway number 2. When money is created as debt, scarcity is artificial and permanent. Takeaway number 3. No system based on infinite compounding can coexist with a finite world. Interest didn't become powerful overnight. It became powerful because it was invisible, because it was normalized, because it was taught without context. The question isn't whether interest will end. The question is who will absorb the cost when it does. Will it be quietly restructured, or violently reset? History suggests only 2 outcomes. If this changed how you see money, debt, or power, share this video with someone who still believes debt is just personal responsibility. Subscribe for more deep history documentaries on money, empires, and hidden systems. And in the comments, answer this. If interest disappeared tomorrow, who would lose the most? Because the answer tells you everything about who truly holds power.